With both Congress and the Federal Reserve riding to the rescue with ever more stimulus, will the current melt-up in stocks ever end? Or have the markets truly become too big to fail? Well, we asked that question of today's guest expert, Sven Henrich, one of the few true masters of technical analysis. And in giving us his answer, Sven shares with us the 5 key charts that he thinks are most predictive of what's likely to happen next. You're going to want to see that data. Oh, and if you've been enjoying the amazing guest experts that we've been having on this program recently, please take a second and click the like button below, because the more likes these videos gets, the more big names we can attract to the program. And now, let's watch today's market update video featuring Sven Henrich. Hi folks, Adam Taggart, co-founder of peakprosperity.com here, back for another week of trying to make sense of these markets. This week we have a total treat. Our guest expert is the technical analyst Sven Henrich. Sven you might be familiar with because he appears on CNBC, CNN Business, and Market Watch frequently. His analysis is in high demand there. He is the founder and lead market strategist at northmantrader.com, which is one of the preeminent technical analysis solutions out there. It's something that I follow actually on a daily basis, including Sven's Twitter feed, which is a work of art in itself. Anyways, we're super lucky to have him here. Sven, thanks so much for joining us.
Thanks, glad to be with you, Adam.
All right, we are joined as always too by the lead partners from New Harbor Financial. This week, John Lodra is on the road, but we are joined by Mike Preston. Hey, Mike, thanks for joining in.
Hey, Adam. Hey, Sven. Nice to see you guys.
Good to meet you, Mike.
All right, let's get started here. Sven, I've got so much to ask you because, as I mentioned, I'm such an avid reader of your work. But before I do, I always like to toss the ball out there, not giving any of my personal bias to our guests so that they can literally just be themselves. But if you could just tell us, what is your general assessment of the state of today's markets?
Well, in a short form, I'd say it's a circus. I mean, it's, you know, we've gone through a number of business cycles in the last couple of decades, and you got to realize that what we're seeing now is unprecedented in many different ways. Obviously, the health crisis that came with COVID was unanticipated. No one could have seen that in advance. The challenges logistically that are taking place globally with economies are, again, never seen before, and we need to work through a unknown virus that is going to continue to present a challenge. Now you can argue about vaccines and this, that, the other. None of us will know exactly how that plays out. What we do know is that the response from policymakers in 2020 has been distorting markets to a level that we've never seen before. Call it maybe unintended consequences, if you will. It's basically a continuation of a pattern that we've seen over the last 20 years, which is, you get a recession, you get an economic event, and central banks intervene. And obviously, what we've seen over the last 10 years is that morph that process into a form of permanent intervention. 2018, they were supposed to kind of try to pull themselves out of the monetary monstrosity, as I call it, with low rates and QE and balance sheet expansion, and that failed when the 10-year for the first time hit 3%. And 10-year at 3%, we cannot even fathom them right now with yields having completely collapsed. And so 2019 was interesting because we had a massive rally in markets on no earnings growth whatsoever. The Fed came in with repo, because remember there was issues in the market before COVID even hit. It was the repo overnight lending rate that spiked in September of 2019. The Fed felt compelled to intervene, and so they actually were raising their balance sheet going all the way into before the COVID crisis, right? That's why we got this kind of blow off top in February. Then the crisis hit, we had a 35% crash. And what we've seen since then, and I think everybody needs to understand, is it's not only monetary stimulus, but it's also fiscal stimulus. It's not only QE and zero rates, it's also M1 money supply. There's a chart I brought with you that shows basically a complete link for link with M1 money supply and the S&P. So what we're seeing on the one hand is just this unprecedented event in the sense that we are in a global recession and we have the highest market levels ever seen in history. typically what you see in recessions is that there is some sort of correlation between the economy in general, job losses, high unemployment, and market levels. Not this time. They've intervened so hard this time that they, in my view, have created a massive asset bubble. What's interesting to me here is that this asset bubble primarily manifests itself in 5 or 6 stocks. It's this incredible tech boom that we're seeing, and not entirely undeservedly so. I'm the first to admit that. I'm saying, yeah, these tech companies have benefited from the brick and mortar competitors, if you will, to being shut down or hurt or what have you, and everybody going towards tech to certainly be able to transact goods and services. But it's taken on forms that are just beyond ridiculous at this point. And I'll finish on this point and say basically, what we were lacking in previous bubbles or in the previous corrections in the last few years was retail participation. Well, retail is here now. Retail is chasing everything, on a Robinhood. See Tesla, see Apple. It's a perpetual machine that is willing to pay whatever price, irrespective of valuation, earnings, or what have you. And that is a very, very dangerous game. And so what we'll find ourselves now, and I brought 2 charts on this called XVG. It's the equal weight basis. I think these are really interesting to highlight. The first one is basically just showing equal weight vis-a-vis the S&P in the last year or so. And you see that equal weight, which basically means you value each stock, let's say at the same price, at $1,000, and you track them individually and see how they react relative to each other, as opposed to market cap weight, which is what most indices are based on, like the S&P, for example. And what you see is that on an equal weight basis, while the S&P has made new highs here, equal weight, the market is massively lower. In fact, you see it even lower than it was in June, despite these new highs. So there's a massive internal divergence. And if you take the second XVG chart here, you look back further in history. And what's fascinating here is that we are even below the 2007 highs. I mean, this is the market is so incredibly weak underneath, right? I mean, the banks are down over 35% on the year. Small caps have improved. They're also lagging. Obviously, a big financial component in there as well. And then if you look at the NYSE, which is the broader index chart, that actually just dropped below the June highs as well. So the S&P now, 25% of the S&P are now 5 stocks, which is the most concentrated weighting since we've seen since 2000. These 5-6 stocks, they're pulling these indices up. And so as much as wealth inequality we have in larger society, we also have it in the stock market. That to me is unprecedented in the sense of the market cap expansion that we've seen. And then just the final point on this, just to put this all together, in my view, and we can get to that, the Fed has, by exacerbating these market valuations, has created a really unique circumstance. And that is the top 1% did not get hurt in this recession. It's literally the bottom 50% that are getting hurt the hardest. They don't own stocks, their jobs are gone, or they are depending on unemployment benefits. So this is the most unequal recession ever. And I'm concerned about what the larger societal impacts are on that. But that's a macro discussion on itself. But bottom line is we're in a massive bubble as far as I can see.
All right. So I only have about maybe 50 or 60 questions in response to what you just said. I'll try to keep it as brief as I can. But thanks, Sven. Great summary, and totally uncoached. But a lot of what you said is similar to what we've been talking about with folks on past weeks' videos here. And we get a certain coterie in the comments section that just says, hey guys, you're just angry because you're wrong, that you keep thinking this market's going to eventually roll over, yet it goes up week after week after week. And so, Sven, you're saying we're in a bubble, and I guess we're just wrestling with the standard, dichotomy you have when you're in a bubble. It's either different this time or it's not. So you mentioned the monetary and fiscal stimulus. We've had that before, but we do have it today at extremes that we haven't had, at least sort of in living memory. You mentioned the concentration in the top key stocks, most of them tech stocks. there are definite concerns to be made, and I think you voiced a lot of them, that these companies have not only benefited from COVID, because of the virtual economy, but their own sort of antitrust power, right? That these are monopolies in many shapes and forms. So anyways, I'm always reminded of John Hussman's comment about asset price bubbles, which is that they force you to either look like an idiot now or look like an idiot later. Do you believe that it is that binary that either investors have to, if they learn to love the bubble and just embrace it, they may be jumping into the look like an idiot later camp when this all bursts? Or is there a potential that the fanboys are right and that it's a different game and that we may not have a major correction here given all of the liquidity that's getting pushed into this market?
Well, first of all, let's recognize the bulls are fully in control here. The liquidity machine is complete in control. And yes, we are now up 5 months in a row. We see massive technical extensions that have not mattered. Internals weakening on these new highs, and believe me, they're atrocious. I mean, we made new highs on S&P this week on negative internals. I mean, all of these are your classic warning signs. But if arguing with everybody's a genius, let's put it this way, in chasing a bubble. I remember 2000 very well. Everybody was a genius chasing pets.com to the moon, right? You can be long until you're wrong, I suppose. But it's like arguing with drunks in a bar. You'll never get anywhere. And the danger and the temptation in any bubble is that people will want to rationalize the price action with narratives. You see that in Tesla right now. I mean, I'm not picking on Tesla in particular, except to say, obviously, this is a
Feel free to. I think it's worth it.
It's vertical, as are many other stocks, even with Apple. And so, in order to justify the valuations, you can come up with any kind of futuristic scenario and narrative, and that applies to Apple as well. As long as price keeps going up, the temptation is there to want to believe whatever, and with that comes the desire to pay for whatever, because there's always the belief that someone will be paying higher up the next day, and that works. That's a classic momentum. The problem is and that happens every time, is when the momentum breaks for whatever reason. That it doesn't even need to have a headline. It's just ultimately technical, and then the headline gets attached in hindsight to it. Now, it's been said, rightfully so, bubbles can remain irrationally longer than you can remain solvent. And so, attempts to fade is very difficult, and it requires a lot of discipline and patience, I may say. I mean, I'm not shorting Tesla or any individual stocks. I think that's kind of a mug's game in a momentum scenario. But as we saw with Kodak the other day, right? I mean, this is maybe Kodak is a perfect example of what I just said. Complete unrealistic narrative attached with it. The stock trades to 60, people chase it, and then it collapses. Then it comes the next chase. None of this is investing behavior. Okay, let's be very clear. This is momentum-driven greed. Let's call it what it is. It's greed and get-rich-quick schemes, if you will.
Yeah, and I might just sort of add ignorance in there, in the sense that you mentioned that what we're finally seeing in the markets now is the retail money coming on in that we hadn't had in there before. And there's sort of an old saying in the world of investing that, for the game to be over, you need to find the patsy to unload all the losses on. And could we be seeing the patsy finally enter the situation here?
Well, if you look at, again, hedge funds, completely underperforming. Even large cap macro funds are underperforming. Again, unless you are heavily exposed to 5 or 6 stocks, you're going to be underperforming the index, the benchmark. This is the distortion that we have. The concern I have is, obviously, and I've voiced that in the past before, is that the Fed, in their quest to save the economy, have put in place the conditions that have brought about all this. And the danger is that when an asset bubble pops, and you get the reversion to the mean. Right? If you get back to a more reasonable valuation regime, the turn in equity valuations itself impacts the economy negatively. And I'm actually surprised. I mean, I shouldn't be surprised that the Fed, as in my view, has been again completely reckless. They, in my view, brought about an asset bubble in early 2020 with this repo operation. They're obviously continuing to be in denial that they have anything to do with asset prices. It's the big Fed lie that they keep telling everyone. They're also claiming they have no impact on wealth inequality, which is completely idiotic, frankly. And well, it's disingenuous on a very basic level. And so they keep letting this thing run hot. And according to themselves, to the Fed speakers, they are claiming they're willing to let inflation run hot, which is an interesting concept coming from a group of people that haven't managed to reach their inflation target in the past 10 years. But let's be clear. If they were to reach their inflation target and let it run hot, they're actually going to hurt the consumer because inflation is a tax on you, right? So I see there is some, intellectual inconsistency in the whole matter. But that's the situation we're in. We're in a high momentum field, and we'll see.
We've talked a lot in previous weeks here about the role of the Fed and sort of from our perspective, it's looked as the hero putting out the fire when in fact it's most likely the arsonist that started it in the first place. We agree with you that the long run danger here really is the damage it's doing to our culture and to society through the inequality that its policies are driving. And that inequality only gets impacted further if there's a massive stock market crash that would then indeed lead to further layoffs and corporate bankruptcies and stuff like that. So it's a sad world that we're living in right now, where the Fed is still looked at as the hero, where in many ways, from our perspective, it's really the villain in the story. Well, look, Sven, you're based in the UK. It's late your time. I know we've got limited time that I want to be respectful with, but I couldn't let you go without going through a couple of charts, because that's your specialty. That's your superpower here. So I know one of the things that we prepared you to talk about was sharing some of the indicators that you are watching most closely right now to try to figure out where we are in the story and what might happen next. Is there any particular data that you might want to walk us through briefly here?
Well, first of all, charts are challenged here. Let's be absolutely honest here. I think the what we're seeing in some of these individual stocks in particular has produced technical extensions that typically produce a reversion to the mean. We've seen extremes like this before in the year 2000. And they were even more extreme in the NASDAQ then, right? For example, NASDAQ going over its 200 MA by a certain percentage or what have you, even on the weekly basis for the 50 MA and so forth. So on that level, markets are currently very stretched. But, and keep that in mind, the Fed's role is to calm markets. That's a self-professed goal. And the way they do that is they crush the VIX. And I put out a piece the other day about the VIX, which to me is in kind of a compression pattern, which is interesting because S&P made new highs, NASDAQ made new highs. VIX in February was about 12, 13, right? It's still hanging above 20 here. And I have to question why, because the market in the last few weeks, in August in particular, has been as calm as I have seen it. Tight intraday ranges, 2 or 3 handles for hours on end. We're not moving. Volume extremely low. In fact, we just this week we saw volume on the Spider, the ETF that tracks the S&P 500, be as low as Christmas half day. There's nobody home. No one's really buying any of this stuff. Again, there's momentum trading. We see a lot of gaps and so forth. But all this has produced, again, a compression pattern in the VIX. And my sense is that the VIX, while it has risk to fill its February gap into like 17.5, 18, it's building up for another spike. That hasn't yet to come to fruition. It's OPEX week this week. OPEX weeks tend to be bullish. Next week we have Powell again giving another speech about what they're going to do and how they're going to do whatever it takes, all that stuff. But then we come into September, October timeframe. Okay, that's kind of your period where you would typically expect some volatility. And let's not forget we have a very contentious U.S. election coming up in less than 3 months as well. So given the combination of technical extensions, hypervaluations, vertical stock charts, and VIX compression with the VIX still relatively high, I at least see the possibility that we're going to get another sizable VIX spike. And then the second chart here I'd like to show is the VTI. This is the all market ETF index. Okay, it's Vanguard, tracks the entire market. And if you look at this, there's a couple of key trend lines here. And it's, sometimes it's just keep it simple, stupid, right? And these trend lines have been, this upper trend line here in particular has been in place since, the last bubble. And you see the price actions kind of spike above it here in February, just temporarily. This is a monthly chart, by the way. And so you see how it kind of reverted. So to me, that's kind of key resistance here. So if you put everything together and then look at the top line, you have an RSI that shows a negative divergence. There is resistance here in this vicinity. So it'd be interesting to see if we get a technical reaction into month end. Doesn't mean we can't spike above before then, but interesting to me to see what happens into month end, and look at those monthly closes on these charts. And then in combination with the VIX saying, okay, maybe we can start expecting some volatility. Personally, given where we are on a lot of these charts, forget everything else, forget every single narrative and belief in Fed and liquidity and this and that and the other. What you typically see is a reversion to the mean in terms of the, I call it the quarterly 5 EMA, which is the exponential moving average. Typically, you see in most months, you see at least a tag of it, okay? And I'm not saying it's going to collapse or anything like that. What I'm saying is that when markets are extremely far disconnected, either to the downside or the upside from some basic moving averages like the quarterly 5 EMA, you are really pushing your luck in continuing to want to trade in that trend. At least you would want to see some sort of reversion. And then that's that reversion where it tags that's then you have your battle of control. There's one chart I put in here just for giggles. It's the Apple quarterly chart versus its Bollinger Band. It is so far outside. And if you look at all the history there, when you spike outside the quarterly Bollinger Band, yes, I know it's a linear chart, but I don't care. Just to put this in perspective, there's no history that says that this is a good place to trade along on these stocks. Doesn't mean they can't go higher, as we obviously have seen. And I would have expected something in Apple by now, but clearly been wrong on that so far. The momentum is simply that strong. But don't be surprised for all of history to actually mean something, right? And then at least get a reversion, and then ultimately, if you get these reversions, then you have kind of the battle control. Okay, is this then a buying opportunity? Are we going to get then this rally into the final month of the year, which is kind of typically what you see, or does this all still play as a bear market rally? Because kind of my final point here is this recession, while we're going to see a growth bounce here in Q3 vis-a-vis this disastrous Q2, the structural issues have not gone away at all. Today, we got, again, claims over 1 million. Okay, this is not a sign of an economy that's healthy. That's not a sign of a V-shaped recovery. Okay, if anything, what that says is there's still big issues going on underneath, and companies are laying off people. A lot of the jobs losses have become permanent, and if you want to claim Apple and these high cap tech stock companies are the safe havens, at the end of the day, at some point, they still need consumers to buy stuff. Right? They need eyeballs. Apple needs to sell phones. This, that, and the other. So, if you look at it in this context, the recession or the structural issues of recession, they may take at least 2 or 3 years to play through, assuming we get this COVID thing under control with a vaccine even. But just looking here around in the UK, man, I see a lot of retail stores shut down, businesses have disappeared. This is not over by any stretch of the imagination. But
Yeah,
that's
same
what
thing.
markets want you to believe. Markets want you to think it's all fine. It's not.
It's not. And first off, same thing here in the U.S., especially in commerce havens like New York City. I mean, you're hearing terms like ghost town to describe a lot of what's happening with businesses there. And to your point about markets want you just to believe that everything is amazing. The current state of markets really is, they're so rumor driven. They're so headline driven, whether it's the latest vaccine, half rumor, or today, it's they're dragging out the China deal headlines again. I mean, nobody expects this deal to happen in any way, shape, or form, and yet it's still good for a couple of points on the S&P. So we're stuck sort of in a market that is long-term driven by the central banks or the stimulus, and short-term driven by algos. And I guess my question for you is, and I know I'm asking you to speculate here, Sven, but what do you see as some of the triggers that might actually break that stranglehold?
Well, I think that the market has now priced in, obviously, a lot of good news in terms of earnings growth and the narrative in terms of reopening and the narrative in terms of a vaccine. And I think we're rapidly approaching the moment of show me. Okay, you can play this momentum game only for so long. At some point, you're going to have to back up these valuations, And I threw in two charts as well just to kind of close this out. I keep talking about this market cap to GDP. There's two versions of this chart. One is the overall level. The peak in 2000 was 150%. That was the extreme that we've ever seen. And then we saw it again in January, February this year, and now we've just gone off the cliff here, almost 180%. Now this number is going to come down because GDP is going to rise, but if you look at the second chart here, the disconnect between markets and the economy has reached proportions that we've never ever seen in history. And typically, even in recessions, you would see some sort of reversion on this. So everybody that keeps playing long here is betting implicitly on it being different this time, and that a high valuation regime will continue indefinitely. That's a bold bet to make. In terms of the trigger, I can think of all kinds of triggers. I think that it's kind of a speculative game, because I can tell you always the trigger in hindsight. Oh, that was obvious. Or well, who could have seen that coming? But I think those triggers are many times just attachment purposes. Ultimately, what happens is that the technicals are in place, and then the technicals are the obvious ones to say, okay, well, they used this trigger, but it was obvious in hindsight that maybe buying stocks at 180% market cap to GDP may not have been a really good idea, right?
Yeah.
I will say one thing. I'm not a political person, but obviously I'm watching what's going on here with this election and with the political climate in the United States. I think it's atrocious. It's completely counter to, or not, it's not conducive to any structural solutions to ever being implemented. I think structural solutions are really hard. And they involve pain. No one wants to deal with pain. And so keeping everybody distracted with, dividing everyone and getting emotions hyped up and people hating on each other, it's actually method, because as long as you have that, no one has to confront issues. And the Fed, unfortunately, keeps bailing out politicians by making the pain go away. I mean, let's face it. Whether you're right or left or whatever, this was poorly managed. It's just a plain fact with this virus. But the Fed comes and bails out politicians, and so they don't have to worry about it. And I think that's ultimately a terrible thing to happen. Now, here specifically, just to make the final point here. Donald Trump has been very vocal. He says if he loses, the election is rigged. He said that. I'm just quoting him, right? So you get to a point where you wonder if we are not going to have the U.S. tradition of peaceful transition. I think if something like that were to happen and you have a very contentious result that is not accepted by one party, things could get really ugly in November. I hope that's not the case. I hope we get a clear result one way or the other. and move on. But there's every day, every week, we're seeing things that we've never seen before. And so far, markets are ignoring these. But there may come a point when something could happen on the political front that's not confidence inspiring. Let's put it this way.
Yeah, that would certainly be disruptive. Well, look, Sven, you've given us a ton of time. Thank you so much. We're going to let you go because you're there in the UK. It's late your time at night after a long day following the markets. Thanks so much for joining us. In parting, you do technical analysis. You do not give individual financial advice. Not asking you for it, but interpreting from your words, it sounds like you would be encouraging the average investor today to at least exert some prudence and some conservatism, and maybe be playing defense more than offense, given the risks in this market. Is that a correct summary? Is there anything else you'd add to that?
Well, everybody has to decide for themselves. I think it's just an understanding of risk versus reward. I think, the danger obviously is that you get enticed into chasing these, and it's been working. Now, look, I can't argue with it, right? I mean, Tesla has been going from $200 to $2,000 in a year. And even the CEO came out in May. Elon Musk said out the stock
it's too high. Yeah,
it's too high. Well, that was what, $1,200 ago. This is the danger with all this. And as I said earlier, everybody's a genius in a bubble. Right? You can't go no wrong. Just know your risk, know your stops. Know your exposure if you want to play that game, and that's the thing on the fade side as well. Got to know your risk reward and know when things change in the makeup of the market. So far, at this very moment here at the OPEX week of August, things keep chugging along. Every single dip is bought. There will come a time when dips are not bought. And I would probably just leave it at that and say, in February and in January, nothing was stopping this market either. Volume was very low, price ranges were very tight, and everybody kept calling for higher and higher prices. And then we had a 35% crash. Now you can argue with this much Fed money in the market, we could never have anything like that. Well, guess what? There was a ton of Fed money in the market in February as well. And it did crash. So control may be the illusion. So for now, bulls are in control, but again, things can change quickly.
All right. Well, just to parrot some of your words that you say often, tops in markets are processes, but corrections are events, which is sort of what you're saying there, which is as happened in February.
I mean,
you can have a trapdoor.
This is your classic thing, right? I mean, it just defies every reason or rationale. It keeps on ticking, and I think tops are probably in when every bear looks like a complete idiot, and everybody's gloating on Twitter how much they've made, But what's interesting to me, psychology-wise, is everybody's forgotten the crash from February. No one cares anymore. It's gone.
Well, Sven, there are 1,000 questions I still have for you. I hope at some point we can have you back on in the future to address at least some of them. But thank you for the great work that you do. And for anybody who would like to follow you and learn more about your work, or maybe even subscribe to your service, where should they go?
Well, the website is northmantrader.com, and you can see me on Twitter at northmantrader. So there you go.
All right. Well, Sven, thanks so much for staying up late and joining us and giving so much of your time. I'm only going to mention this because you've been public about it, but I know that you had a family member who was stuck away from home due to COVID, and they've recently returned. So congratulations on that.
Thank you. We're glad to have him home. It was 5 long months.
Oh. Well, anyways, best of luck to you, Sven, and we'll keep watching your work and following these crazy markets.
It's never boring, is it?
It never is.
Thanks, Adam. Thanks, Mike. Take care.
Thanks, Sven.
All right, Mike. Gosh, what a treat, huh? Listening to Sven. I know that you, like me, follow Sven's works pretty closely, huh?
Yeah, we do. We follow really closely. He said everything that, everything and more that we watch. You know what I mean? And I think he was even being nice in terms of just holding back, saying just how extreme things are right now. They are extreme, and then some. the gloating, the end zone ball spiking that's going on by those that are, in the market or bought the dip or didn't sell is pretty extreme. But the indicators that we watch are, the list is getting longer and longer and longer and longer. A lot of what we do is technical work and look at technicals, and Sven is the master at that, and he did a really good job of going through that. But the risk is, seems like every week we talk, the risk is a little bit more, and I think it really is. As hard as it is to say it every week, it's the truth.
Yeah, and that's what I really appreciate about the very few financial advisors I know of like you guys. Your job is sort of to be going around the Titanic and telling people, look, that bump that you felt was a big deal, and actually, it's going to have repercussions, and we should all be taking smart defensive action now. And yet the music's still playing, the canapes are still being served by the tuxedoed waiters and whatnot. And so there's a lot of people out there who still are just sort of blithely ignoring or not wanting to hear that message. But you guys are doing a good job of getting, more and more of the people who will listen to actually look at the data, see the boat's got a gaping hole in it, see that the compartments are filling with water and that the boat probably won't be able to stay afloat, and getting them into life preservers and towards the lifeboats. So let's talk about a couple of things. First off, let's just look back at the previous week in terms of the action that's happened in the markets. It's been a fairly busy week for me at Peak Prosperity, so I haven't been watching the markets as closely as I normally do. But from my quick viewpoint, it looks like we've just seen a lot more of the same. I actually thought that we might have a rare down day in the markets to talk to Sven about, because all the indices were down, in the red 0.5% or so this morning. As usually happens, they all got clawed back to green by midday. No down days allowed. Actually, one of my favorite Fed charts, I'll try to put it up here as I'm speaking, Sven charts, is a chart that says August 11th will live in infamy, because it's been the only down day in August so far this month. And we're at what, August 20th or something like that at this point. But has anything happened to the market that's worth putting on people's radars?
Oh, not that much. As Sven said, all the indicators are bullish. It hasn't even mattered really in the last couple of months, because when we actually did have bearish indicators like an island reversal and some shorter term bearish engulfing candles, it hasn't mattered. Liquidity has just kept pushing this market higher. So, I'm looking at the S&P right now. It's actually at the moment up about 10 points, versus last week. Depending upon what tomorrow happens tomorrow, we may not even have an up week. Tomorrow is options expiration. It does have a bullish bias, but it also has a tendency to be somewhat volatile. But markets just literally are climbing a greater than 45-degree angle every single day, every single week. And we hang out near the highs at the single most overvalued point in all of history. Market cap to GDP close to 180%. Cyclically adjusted PE ratios up in the 30s or even maybe in the 40s if you're adjusting it for margins, like John Hussman does. Like you said, Hussman says you can look like an idiot before or an idiot later, and trust me, we money managers that have been out there warning, know what it's like to look and feel like an idiot beforehand. But the data is just that extreme. This morning, like you said, we opened down. The New York Stock Exchange has a piece of data called the tick. And it's like 2,000 stocks on the NYSE. The NYSE tick opened at minus 14, which says 1,400 plus stocks opened on a down tick. That's pretty extreme. We haven't seen that type of open since June. And yet, that was a 2-month extreme. And yet, from the first second, the market just bought all day long. We're seeing a lot of other technical things that Sven didn't mention, like put-call ratios. 20-day averages of put-call ratios are extremely low, going back to 2000, 20-year extremes in terms of lopsided bullishness. All of that says it doesn't matter till it matters. I feel like we say the same every week. We'll keep saying it. One of these weeks, there will be a reversal, and we don't think there's going to be a lot of time to adjust when it eventually happens. So take a look at your portfolio, get down to 30% or so below that in stocks so that you'll have ability to weather the storm and react to lower prices. We still think that there's deflationary forces in this market that the Fed is trying to beat. It seems like they're winning, but we think that deflation will take over eventually. And lastly, I'd say, Sven mentioned this, we could very well still be in a bear market rally. even though we just hit new highs in the S&P. We've showed this chart before that says this is the return to normal phase, or a second wave rebound, as Elliott wave chartists would say. The most powerful counter-trend move in an entire bear market is that second wave. Everyone is convinced that we're back to normal. And I'll tell you, everyone's on the same side of the boat here, and the technicals are screaming danger. So we're going to keep doing the same thing, and that's caution.
All right. Well, one other thing to mention about the week is that Apple crossed the $2 trillion mark. First company ever in history to be worth $2 trillion. What's amazing that to me is I don't have the stat at the top of my head, but I don't think it was a couple years ago when we had the first company worth $1 trillion. So, all of stock market history to get to 1 trillion, and then literally just a couple of years to get to 2 trillion. And if you look at Apple, Sven put that chart up earlier. If you look at Apple's price rise, it's largely done on what's called multiple expansion, which means the valuation that it gets related to its earnings, which is the profit it actually generates, has been expanding. And Apple has actually not been growing its revenues all that much over the past year, which is actually past year and a half, which is actually a really big danger sign for a company. But investors have been giving it more and more credit for the earnings that it has than they have in years past. And so that's why you end up with charts like with what Sven showed, where the monthly chart is just way outside the upper Bollinger Band. And Bollinger Band folks are just the trading range that the stock normally trades in. So as people talk about reversion to the mean, anytime it's near the top of its Bollinger Bands, it will usually eventually reverse to go back to the middle, maybe retest the other side of the band. Apple is just completely outside of that Bollinger Band. And so you would expect some massive snapback from that type of exuberance, because usually when you see that in the markets, it does not last. So that goes to what you were saying, Mike, which is right now the markets aren't caring. The average person isn't caring because they're just happy to see their 401k a little bit higher. But the people who are really paying attention and are data-driven and students of history, they can see all the warning signs that you mentioned, that Sven mentioned, that we've been mentioning on past podcasts. And more people are asking that question, hey, I don't want to be steamrolled by this thing when the reversion to the mean, reality reinserts itself, history repeats, however you want to say it. But whenever that happens, I don't want to be roadkill along that way. What can I do today to position myself for safety and to preserve and protect my wealth? And that's why you guys are here on these videos with us every week, because there aren't that many financial advisors out there that think like you guys do, like Sven do. And it's really hard for people to figure out what to do, because this is, as we've said it from week to week, this is a super challenging time. In fact, it's probably the most treacherous time for investing in our lifetimes, just in terms of the risks that are involved. Sven mentioned the risk-reward ratio. The risks seem way higher than future reward does at this point in time. But where do you position yourself, right? If you park in one place for too long, you could get killed by inflation. If you get parked in one place for too long, you can get killed if markets correct, and that's deflationary. So we always recommend working with a financial professional advisor that is aware of these risks, can track them on a day-to-day basis, and honestly can be your guide in terms of where to put your money and when. Sadly, there's no one set it and forget it solution these days. You need to have somebody who can be nimble and react to what's going on in the markets. So anyways, Mike, I'm going to give my normal kind of commercial for you guys, which is, look, if you've got a good financial advisor who knows these risks and is helping you chart your way to safety, awesome. Stay with them. They are worth their weight in gold. But if you don't, or you're having trouble finding one, feel free to talk to Mike and the team at New Harbor Financial. This is just a public service that New Harbor and Peak Prosperity have worked out to help people, because at the end of the day, we just want people to be better informed to make better decisions. So you can set up a consultation with New Harbor. Mike, I'll make sure that we've got the Greylock Peak URL up on the site whenever you're talking during this video. And again, folks, these consultations, totally free. You don't have to work with these guys. They will just sit down with you and look at your portfolio and answer any questions you have. And if that's the only conversation you have with them, that's completely okay. If that's of interest to you, stick around to the end of the video, because we kind of give you the instructions on what to do, how to do all that. And with that said, Mike, anything else that's worthy about talking about before we clock out here and then see each other next week?
I don't think so, except maybe I would mention gold miners. Gold and silver are on a pretty significant pullback off their high. Gold miners GDX pulled back to the low 40s. We still like miners here. They've taken a big run. We would definitely consider holding them, even adding them to a new portfolio with appropriate hedges. We have hedges in place to make sure that we can withstand any short-term whipsaws. But still, we think the best places to be are in cash. Miners have some exposure to gold bullion, preferably gold bullion you can get your hands on, and silver bullion. And wait for what we think is still likely some kind of deflationary wave, so that you can buy stock market assets or some real estate assets less expensively. So it's getting long and exasperating for everyone, certainly for us as money managers, but we see this as one of the most extreme times in history, maybe the most extreme markets in our lifetime, like you said. And it's going to pay to be vigilant. So with that said, hopefully we'll have something interesting to say next week.
All right, great. Well, great talking to you, Mike. Again, what fun to have Sven on. And we're going to have, I already know the guests that are lined up for the next couple of weeks, and they're just as good. So it looks like we've got a couple of fun conversations coming up for us. So anyways, thanks for participating this week, Mike. Thanks everybody for watching, and we'll see you all next week.
Thank you. Thanks, Adam.
If you'd like to schedule a consultation with the financial advisors at New Harbor Financial, simply go to greylockpeak.com. These consultations are completely free and there are no strings attached. The good folks at New Harbor will simply answer any questions you have about your investment goals or your portfolio and give you their best advice given the latest market outlook. They're willing to do this because they care about protecting people's wealth and because Peak Prosperity has connected them with so many thoughtful investors just like you over the past decade. Chris and I started doing this because so many people have approached us in frustration and are looking for a solution because they're feeling out of alignment or just downright ridiculed by the standard sort of financial advisors who have been managing their money. You know the type, the kind that just pushes all of your money into the market, scoffs at the idea of owning gold, and when you bring up concerns about the market's sky-high valuations, they say, don't worry, the market's always going to take care of you. For many of the reasons discussed in today's video, we think this is one of the most challenging and treacherous times in history for investing, which is why we strongly believe that today's investors are best served working in partnership with a conscientious professional advisor who understands the risks in play. Now, we're agnostic which professional advisor you work with, just as long as they're good. If you're already working with one, that's fantastic. Stick with them. But if you aren't, or you're having trouble finding one you respect or trust, then consider talking to John and Mike and the team at New Harbor. And for those about to ask, yes, there's a business relationship between Peak Prosperity and New Harbor, which we had to put in place to make sure that everything is handled according to SEC regulations. All the details on this are clearly provided on the greylockpeak.com website. Also, it's important to note that New Harbor is able to work with U.S. citizens, green card holders, and those with existing assets in the USA. But for regulatory reasons, they aren't able to take on non-U.S. clients. All right, with all that said, if you'd like some insight and guidance on how to protect your wealth during this unprecedented time in the markets, go to greylockpeak.com to schedule your free consultation with the good folks at New Harbor. Thanks for watching.